Okay, traders, so I'm doing a part two on this because when I did part one, people gave me some flack. How dare you give me flack? But no, it was good. You guys had some questions, misunderstandings, and misunderstandings are excellent because they're opportunities for learning. So this is a really important issue when trading options. Most people, again, the concept is they say you should buy options when implied volatility is low. And my point in part one was sort of. That's an absolute maybe. But the other detail, the dollars are in the details, is that not only do you want to buy them when implied volatility is low, you want to buy them when it's trending up. Not the price of the stock. Well, yeah, the price of the stock too. But my point is, it's not as simple as buying low implied volatility. You want that implied volatility to be trending up. Even if it's not rock bottom, you want it to be moving up. So here is a screen capture of what I showed in the last one. So you can see the arrow there, you can see the arrow here, and this was the point that IV, implied volatility, it's part of the pricing of the option. Options have, they're multifaceted in their pricing. So you got the price of the underlying security, you got interest rates is a little bit of it, the strike price, the number of days until expiration, and a volatility value. So what today we're focusing on is the volatility value, namely implied volatility. So some people said, well, sure, price is going up, so implied volatility is going up. I didn't need any special lesson on this area. Obviously, if price goes up, volatility is going to go up as well. And that is not 100% correct. So the people who said that, I don't think they're really understanding what implied volatility is. You've got two types of volatility. Well, two types we'll talk about today: historical volatility and implied volatility. And then actually you've also got the volatility of the market itself, the stock itself. And implied volatility is different. So just because price goes up on a stock does not mean that implied volatility will go up. That is not a given. Implied volatility, the key word there is implied, well, IMP. Okay, so that refers to what the market expects the volatility to be in the future, not what it is now, and not what is happening as bars continue to go forward. So that was the misunderstanding there, is that no, it will not necessarily follow. It may or it may not. And my point is, you want to trade when implied volatility is trending when you're buying a call or put option, because you want part of that pricing of the option is the volatility, the IV, and you want that to go up so that the price of the option is going up, because sometimes the stock can go up and the price of the option will not go up. So they're not strictly correlated necessarily. So to help us make more money, we want that price or that part of the option pricing model to be going up as well if we're simply buying a call or buying a put. Okay, so implied volatility, again, is more of a theoretical value, what the market thinks will be the volatility in the future. Now, along with that, someone else said, well, it's going up because there was earnings coming out, quarterly earnings, and that was a more educated answer. And that's true. Quite often when earnings are coming or some sort of event, then the market will say, oh, more volatility will come in, but not always. Sometimes the pricing will be already incorporated in advance, and as we approach earnings, it actually gets lower in volatility. And then when the earnings event comes out, then you get an increase. We got an increase before the earnings came out in this case. And then when the earnings came out, price continued to go up, but volatility dropped off just crazy, right, to nothing. So that, again, alone is not going to help you. You've got to watch the actual plotting of the trend of implied volatility, because, again, that's part of the pricing of the option. We want the price of the option to go up if we're buying the option itself. Okay, now let me show you an example of why or of when these things don't always correlate and why it's so important. All right, so here's another example. So in this example, let's say that we were going to buy a put. Okay, we're bearish the market. So here we come on down and IV increases. So here we have low IV, low implied volatility. We break, we've had just kind of a channel here, and as we break that channel, then, for example, this would be a good swing high to buy a put, because now we've got implied volatility increasing the price of the option, along with the fact that the market is going down, the underlying stock is going down, to also increase the price of that put. So that's the concept. So that worked out great, but that's pretty much what we saw before. Now, as we continue to go forward with this example, then the market starts to go up. And as it goes up, well, look at that. Okay, so now here's an example to illustrate the opposite. So the trend on implied volatility is down. The trend on price is up. And so they don't necessarily correlate. And again, here we have an earnings report, and sure, price goes up, but implied volatility does not go up. It's going down into earnings, and it continues to trend down after earnings. So in both situations, it's trending down. It's trending down. So you've got to look at it in itself. And look, again, it just keeps going down. So this would not be, if you had several choices of things that you're looking at in order to say, well, do I want to buy a call, buy a put? The first situation, excellent. The second situation, no so bueno. Because you're not going to have implied volatility increasing the price of your option. That factor in the pricing of the option, helping the price of the option to go up along with the price of the underlying go up. And that is the point of the previous lesson. Wanted to bring some extra clarity to it this time. Hope that was helpful. Feel free to post any comments below or questions you have about this. And as always, feel free to get my rubber band trade, my free gift to everybody who watches my free stuff. It's a gift to the trading community out there. A great trade I have that will give you a real excellent setup, that something that I came across years ago. And I take this trade still to this day every time it sets up. Just go to rubberbandtrade.com, go get it. It's a freebie for you. Test it out, back test it, forward test it, do it on the simulator, and let's get you making some money before you spend money.